Welcome back to the Rock and Turner Investment Podcast. We're excited to have you join us for another episode filled with valuable insights and expert analysis to help shape all of your investment decisions.
Before we begin, please note the following legal disclaimer. The views and opinions shared in this podcast are intended for entertainment purposes only. Any references to regions, countries, sectors, stocks, securities, or other assets are for discussion purposes and should not be considered as recommendations to buy, sell, or pursue any specific investment strategy. This content does not constitute accounting, legal, tax, or investment advice and should not be relied upon as such. The material may include forward-looking statements, forecasts, or projections, which are inherently uncertain and not guarantees of future results. There is no assurance that any predictions or projections will materialize. All data referenced in this podcast has been sourced by us and is provided without warranties of any kind. The data may contain errors and should be independently verified before use. Neither we nor the data providers accept liability for any reliance placed on the information presented. Always conduct your own research, seek professional advice, and take responsibility for your investment decisions.
The following episode delves into some detailed financial analysis. Visual slides are provided to aid with understanding. As such, while you may listen as an audio podcast, you are strongly advised to watch the full presentation, which is available at rockandturner.substack.com.
Michael Burry is best known for identifying the subprime housing bubble and building a concentrated short position before the great financial crisis of 2008. His story was later told in The Big Short movie. People laughed at his contrarian bets, but he had the last laugh. He walked away with hundreds of millions of dollars in gains. Then he went quiet, really quiet, flying under the radar, focused on managing his fund, Scion Asset Management. Then recently, he stepped back into the spotlight. On October the 31st, 2025, he posted a short message on X, formerly Twitter. He said, "Sometimes we see bubbles. Sometimes there is something to do about it. And sometimes the only winning move is not to play." Shortly afterwards, he shut down his investment firm and returned capital to investors. Now, when Michael Burry withdraws from the game, it's worth asking why. Around the same time, he launched a Substack called Cassandra Unchained. That name has meaning. In Greek mythology, Cassandra could see the future. She would warn others, but she was never believed. The implication is clear. Michael Burry thinks he's pointing at risks the market is choosing to ignore. His concerns today centre on questionable corporate stewardship and accounting practices. He doesn't like the way tech companies are extending depreciation schedules. He doesn't like the way that businesses publish skewed adjusted earnings numbers. And he really doesn't like practices around stock-based compensation. In December last year, he published an essay entitled Foundations, the Tragic Algebra of Stock-Based Compensation. And that essay inspired today's discussion. Michael Burry describes some businesses, particularly those in the tech sector, as operating a wealth transfer mechanism. He points to Tesla as an example, noting that shareholders have historically been diluted at more than 3.5% every year due to stock-based compensation. Now that figure compounds over time. Originally, stock-based comp made sense. Bootstrap startups didn't have cash to attract top talent, so they offered sweat equity, shares instead of salary. It's a fair trade. Risk is shared, incentives are aligned. But that's not what we're looking at today. Today, stock-based compensation isn't replacing salary. It's layered on top of very generous base pay. It's cream on top of the cake. It's a transfer of wealth from those taking the corporate financing risk, external investors, to employees. It's essentially a tax on shareholders levied by insiders. And stock-based compensation is arguably the most abused aspect of corporate finance today. Here's a principle that you need to anchor to. There's no such thing as a free lunch. If someone's getting rich, someone else is footing the bill. And in the case of stock-based compensation, it's never the outside shareholder walking away smiling. If you don't believe me, the best example is the case of Twitter. It had its IPO in 2013. Then it was acquired a decade later, adjusted for inflation below the IPO price. 10 years without dividends, a negative real shareholder return. Shareholders got nothing. Nothing. Meanwhile, Twitter's CEO, Jack Dorsey, saw his wealth balloon from zero to nearly $4.5 billion, mostly through stock-based compensation. Alignment of interests? I don't think so. So all of this begs the question, for a profitable company, why not just pay cash? Well, there are a few reasons. So stock-based compensation preserves balance sheet cash. It creates golden handcuffs to tie in valuable employees. It generates tax deductions. And because frankly, it's easier to disguise unjust enrichment. Now, here's where it gets really slippery. Most companies present adjusted earnings by adding back stock-based compensation because, wait for it, it's a non-cash expense. The implication is that there is no cost to the company. They would have us believe that they magic financial riches for insiders out of nothing. Pure alchemy. Warren Buffett summed up this behavior perfectly. He said at one of the Berkshire Hathaway shareholder meetings, if options aren't a form of compensation, what are they? If compensation isn't an expense, what is it? And if expenses shouldn't go into the calculation of earnings, where in the world should they go? Think about this. Depreciation is non-cash, but it reflects the very real cost associated with the useful life of a company's long-term assets. Deferred income taxes are non-cash, but are nevertheless recorded in the profit and loss account. And frankly, plenty of revenue is non-cash, and I've never seen a company strip out those numbers. Terry Smith, the founder of British investment firm Fundsmith, put it perfectly. He said as long as accrual accounting is the standard, the non-cash argument simply does not pass muster. If you pay people with equity instead of cash, you're still paying them. You're transferring ownership in the company, and ownership isn't free. If the argument is that stock-based compensation is a deferred cash expense, then it's a liability. It needs to be accounted for somewhere, but that's not what's happening. Michael Burry correctly points out that by excluding stock-based compensation from earnings calculations, alongside other accounting alchemy, companies are significantly overstating their earnings. And that in turn results in overinflated corporate valuations. That's the bubble he's referring to. All of this is very convenient for corporate management. Just imagine granting yourself equity and then being able to inflate its value. It's like having the Midas touch. You can quite literally create wealth for yourself. Charlie Munger summed it up well. He would say, show me the incentives and I'll tell you the outcome. If insiders at a company kept dipping into cash balances of the business, helping themselves to the current assets on the balance sheet, shareholders would go crazy. So they don't do that. Instead, it becomes a game of obfuscation. The company issues stock-based compensation today, claiming it isn't a real cost. There's no cash leaving the company. The grant of equity doesn't vest for several years. So shareholders see no cash leaving the building. Everything looks good on the surface. Then, when vesting occurs in the future, to mask dilution, corporate executives use balance sheet cash to buy back shares in the open market. The share count remains roughly the same. But what's really happened? Well, balance sheet cash has been used to enrich the insiders. It's just been dressed up as something else. Smoke and mirrors, sleight of hand, just like a magician. The audience has no idea what really happened, but it looks impressive. Better optics, but make no mistake, shareholders have had their pockets picked. Wealth has been transferred. Corporate capital belonging to shareholders is now in the ownership of insiders. And it gets worse. Buybacks to offset dilution occur years after the stock was granted. The value of the company would invariably have increased over that period. So the company repurchases shares at a far higher value than the price at which it issued them. Selling low and buying high is not a strategy, it's leakage. It destroys capital. Although SBC is an acronym for stock-based compensation, it would be more accurate if it stood for serious bleed on capital, because that's exactly what it is. Between 2014 and 2024, that 10-year period, Meta spent $148 billion on buybacks, and at least 82% of that was spent on offsetting stock-based compensation. It claimed to be shareholder-friendly. It claimed repurchases were a return of capital to investors, but 148 billion reduced the share count by just 4%. You can make your own mind up. Meta is running simply to stand still in terms of the amount of money it needs to spend simply to maintain its share count. But some companies aren't standing still. They're running up a down escalator and they're unable to run fast enough. Take Palantir. Since its IPO, despite billions spent on buybacks, its share count exploded from roughly 905 million shares in 2020 to well over 2.5 billion shares today. In 2020 alone, its stock-based compensation bill was 1.4 billion, which was more than its top-line revenue. Yeah, more than its top-line revenue. That's not a mistake. That's more money going out the back door than coming in the front door. It's not a rounding error. It's a problem with unit economics. Then there's the opportunity cost to consider. All that cash could have been used to fund growth, a benefit to the company and its shareholders. Instead, capital is being allocated to neutralize dilution. Zero commercial benefit at a very significant cost. Good corporate stewardship? I don't think so. Then Michael Burry zooms out and considers the macroeconomics of the situation. When compensation is heavily equity-based, companies can compete for talent by promising more of it. Equity grants become currency that can be printed at will. Talent then flows towards the firms offering the largest grants, not necessarily the firms generating the highest returns on capital. Efficient markets break down as human capital is being misallocated. It becomes a Red Queen scenario. Every company needs to offer more stock-based compensation annually just to stay in the game and remain competitive in the labour market. This in turn necessitates more buybacks to offset dilution. That means a persistent level of artificial demand for the shares of that company. The share price is pushed higher, and then passive capital flows into the largest companies due to cap-weighted indices. So the process begins again. It's a classic case of the George Soros theory of reflexivity. It creates a self-reinforcing, unstable, boom-bust feedback loop. It doesn't take a genius to see the problem, but shareholders, auditors, and regulators have thus far chosen to ignore it. In Berry's framing, this is not a short-term valuation concern. It's structural. Look past consensus metrics. Focus on underlying cash economics. Follow the incentives. If equity is currency, dilution is cost. If buybacks ignore value, capital is misallocated. Over time, the problem compounds. Eventually, the investment thesis breaks. The question for investors is simple. When you analyze a company, are you treating stock-based compensation as real expense? Are you evaluating buybacks based on intrinsic value? Are you adjusting for the steady erosion of your ownership stake? On that thought, allow me to introduce my guest today, Kevin Kohaki. He has an MBA, but more importantly, he has a doctorate in accounting. As an associate professor, he teaches financial statement analysis at master's level at some of the top US universities, and he founded CAE Consulting, where he travels the globe to advise corporate executives at some of the world's leading companies. I couldn't imagine anyone more qualified to talk us through how best to think about stock-based compensation when analyzing investments. Welcome, Kevin.
James, truly my pleasure to be here. Thanks for having me. This is going to be fun.
You did it well. So I know you have some strong feelings on this subject, and you were going to talk us through some examples with some very well-known names.
Yeah, so no, this has been a topic I've been working on for several years. I mean, it goes way back to when I came of age in the late 1990s when stock-based compensation was not considered an expense. The best that you got was a footnote in the financial statements. And then 2002, 2003, the Financial Accounting Standards Board, the FASB, came out with 123R, which said, hey, you need to value these things and you need to expense them. Okay, I was an undergrad in college at the time, so it kind of made sense. And then obviously Warren Buffett, one of my three idols, basically said, look, we still account for the true cost of stock-based compensation. And that always bothered me because it's like, okay, it's clearly not than what 123R says it is. So over the years, I've just looked at this through my own investments, and most of the time it didn't come into play because most of the companies I was dealing with didn't own or do a lot of stock-based comp. But it started to get worse over the last 20 years. And I started looking into it a little bit more and realizing in some cases, this is a very significant issue for a lot of companies. And so it's just when you understand the accounting behind it, you realize that most companies this doesn't impact, but there are certain companies, some of which are the largest in the world, where this eats up most of their profit or most of their cash flow. And so if I'm an investor looking to buy all of a business, I want to make sure that the numbers I'm looking at are true. And the accounting for stock-based comp just doesn't really help with that. So a good analyst needs to know to make certain adjustments, which we're going to talk about today. So let me start with a very basic example just to kind of level set here. If I gave you a stock option or a restricted stock unit or whatever at 30, all right, we're going to expense it on our P&L, our income statement at 30. And we'll probably do that over 3 or 4 years, depending on the vesting schedule. So, whatever, $10 a year for 3 years or 7.5 for 4. And that's it. We're going to add that back every year on the statement of cash flows. So because it's considered non-cash, because at the time I gave you the unit, the option or the restricted stock unit, and I'm going to use the word unit for all of these from now on, they're not shares yet. And so at the time I grant them to you, they're just units. They're not shares. They haven't converted. But let's say 3-4 years later, after these are vested and they're live, they're shares now, the stock is at 90. Well, you as the employee are going to exercise these things or vest, because if it's an option, we say you exercise them. If it's a RSU or PSU, we just say that they vested. And now you sell them at 90. All right. Well, you're going to get $90. The company expends 30. In some cases, that might be all there is. But if the company has a share repurchase program, then they are effectively buying back your shares to offset dilution from stock-based compensation. The argument I always make is that if I'm paying you in base salary or bonus cash, that's an operating activity. Everybody agrees with that. But for some reason, if instead I pay you in stock-based compensation, it's not an operating activity. Therefore, it doesn't show up on the P&L, and it shows up on the statement of cash flows, but as a financing activity. So the way that we normally calculate free cash flow, just cash from operations, plus capital expenditures, which capital expenditures are always negative, so we're adding a negative, we get free cash flow. But we're excluding stock-based compensation. But we wouldn't do this if I was instead just paying you in salary or bonus. It would be an operating activity. It'd come out of cash from ops, and there you go. And so there's this weird distortion. Now, to be clear, I'm not saying that the FASB, the Financial Accounting Standards Board, or the IASB for international companies, because I'm US based, are doing anything wrong. They're not. I understand why the rules are the way that they are. I agree with the rules. But the analyst needs to know to make the adjustment. That's why FASB and the IASB says, look, financial statements are meant for knowledgeable users. And it's like anything else. If you're not knowledgeable, you don't know what you're doing, then any errors are on you. So that's just kind of high level the way I've always looked at this. So compensation to me, I don't care how I'm doing it. It's an operating activity. And so that's the genesis as to why I think we need to make certain adjustments when it comes to stock-based comp. But so with that as an example, I thought it'd be fun to look at a couple of companies, one of which is going to be Meta. I think we should start there because they're obviously one of the biggest companies in the world. And their stock-based comp is relatively sizable relative to their results. So let me share my slides that I've presented for us here. And I'll put these in presentation mode just to blow these up a little bit. So what we're looking at is Meta's fiscal 2025 numbers. They're a calendar fiscal year, I think, so that makes that easy. But let me start with the statement of shareholders' equity. So on the bottom, you'll see that they issued 63 million shares this year for basically stock-based compensation. That's fine. They got a $450 million cash inflow from them. Some of these, it's because they're employee stock purchase plans. So this is just giving employees, stock at 85% of the market price. So we're not really focused on those too much because that's not, one, it's not a big number. Two, not every company does it. It's not the same as stock-based comp, so to speak. But so in the footnote, you'll see 61.9 million shares, RSUs particularly, were vested. Let me go there really quick because there's your footnote. So this is their stock-based compensation footnote, and you'll see the 61,906 towards the bottom, and it'll say vested. So what you have to understand is if it's a restricted stock unit, when it vests, it's a taxable event for the employee. They have to pay tax at that time. Now, they don't have to sell the shares at that time, but they do have to pay tax. Okay, so this 61,906 is in that 63 million I just showed you. So I just wanted to show your listeners where they can find this. The stuff is in the footnotes. It's not like anything is hidden. And so again, I'll be very clear. I don't think FASB is doing anything wrong. I'm not saying that any company is doing anything wrong from a rules perspective. They are disclosing what they are required to disclose. So, this isn't like an Enron thing where they were committing fraud. Nobody, to the best of my knowledge, is doing that. They're just disclosing what they need to. But I don't think investors are really paying attention. So with the 63 million, obviously that 61.9 million is embedded in that. What's going to happen is for those 61 million RSUs that are vested, Meta's going to use the tax withholding method. And so they're not going to give you, James, all 61.9 million shares. They're going to hold back a certain amount and pay the tax for you. And that's partly IRS code because the organization has to basically withhold taxes, payroll taxes for compensation. So they're doing that. That's the 27 million shares that you see right below the 63. So the 27 million shares that Meta withheld for its employees, they ended up paying, as you can see on the right of that line, 18.4 billion out of their cash account. So Meta paid taxes for their employees of 18.4 billion. Now Meta never took these RSUs, sold them in the market, and used that money. It's just they took the units, the 27 million units that did not vest, and basically canceled them, if you will. My understanding is they essentially canceled them, withheld them, and then just paid the 18.4 out of their own cash account. So it's not like there's some cash inflow and then there was an outflow. It's just an outflow. So then what happens if we say, okay, 63 million shares, let's say, or RSUs, minus 27 leaves 36 left for the employee. So the employee walked away with 36 million shares of Meta stock, and that's what they took home in pay. And so the way that I do my math is I just take, okay, 63 minus 27, I get to 36. I say, all right, now Meta makes it very clear that they will offset dilution at a minimum with their share repurchase. And this actually came up on their second quarter 2025 conference call. If you go on their website and you read their conference call transcript, but more importantly, the supplemental transcript, there's an analyst that asked Susan Lee or Susan Liu, I think it's Susan Lee, their CFO, a question about dilution. And she said, yes, a lot of our compensation has gone up because of the compensation that we're paying to our AI folks, but we are going to essentially offset all that with stock repurchases, offset that dilution. And I'm paraphrasing, of course, but anybody can go find this on their website. And so you can see the 40 million shares right below that they repurchased. All right. Well, what I need to do is figure out what's the average price of that. So 26.264 billion divided by 40 million shares is whatever number that is. whatever that per share value is, I'm going to take that and I'm going to multiply it by the 36 million shares that were actually given to my employees for stock-based comp. That's 63 minus 27. And that is going to be the stock-based comp cost to offset dilution. So, and let me do this real quick because I got my handy dandy calculator here. If I take 26,264 divided by 40 million, I'm going to get $656.60 a share. So 656.6 times 36 million shares. That's about 23.6 billion in cash that Meta paid to buy back stock to offset dilution. I'm going to add to that the 18,400,000,000 in cash taxes paid to the IRS. And I basically get just over 42 billion in total stock-based compensation cost, if you will, for 2025. Okay, well now, right in the middle, you will see share-based compensation for 20,427,000,000. That 20,427,000,000 is what showed up on their P&L. So that's what they expensed, because under RSU accounting, basically, when I give you the RSUs, whatever the market price of the stock is, that's what I'm going to put on my income statement as a cost. And I'm going to do this over 3 or 4 years, just depending on the vesting schedule. They're usually 3 or 4 years. So that 2427 is going to get divided by 3, 4 years. That's what goes on the P&L. What I'm saying is, let's just say the 2427 was expensed all in 1 year, okay? But I just told you the real cost is 42 billion. Obviously, there's a gap here. There's a $22 billion gap that never shows up on your P&L. And so right there, your P&L is incorrect.
Kevin, can I just jump in with a quick question there?
Please.
A lot of investors, kind of naively, I suppose, will look at cash flow from operations. They'll look at the line item that says stock-based comp, and they'll take that as the number. I'm just looking to compare your 42 billion to that particular line item here. Do you have that to hand?
So yeah, so I'm sharing. I'm sharing my screen. Are you seeing the statement?
I can see that.
Right now? Yep.
They're showing 20.4, right?
Yep. Third from the top.
Okay, so the number that most investors will take as the share-based comp for Meta for 2025 is less than half the real number.
Yeah. Yep. And we see this with a lot of big companies right now, particularly the AI hyperscalers.
And more particularly, that 42 billion is cash that's flown that flows out the company.
Exactly.
Whereas this share-based comp on cash flow from ops, they'll claim as a non-cash expense and they'll add that back in.
Correct.
So okay.
And it's not technically wrong, because at the time I gave you the units, it was non-cash. And so then people will say, I've had these conversations recently. They'll say, well, why do they do it that way? Like, why do they expense this at 20,427,000,000, when it's not going to be realized for several years? Very simple. In accounting land, it's literally, when I still taught undergrads, it's the second accounting rule that we teach them. The first is revenue recognition, but it's known as the matching principle. So if you work for me right now, and I'm paying you right now, I have to match your expense to the revenue it generated in the period it was generated. So for all of Meta's employees, they're working for Meta. What they do helps the company generate revenue in 2025. So I assign a cost to their labor in 2025. But the actual total real cost that we just calculated, that 42 billion that gets realized years later, that's different, obviously. It's a different, higher number. But in accounting land, we have to follow the matching principle. And so again, everybody's following the rules. It's just that you need to know to make the adjustment, because the real cash cost shows up later.
So now, this 20.4 number that appears on the cash flow from ops, that's, tell me if I'm wrong here, but my understanding is that is the perceived value of grants that were made in 2025 based on the market price at that particular time, notwithstanding the fact that we don't know the true cost of those grants, because we won't know until vesting several years later. It was likely to be far higher than that. But of course, Meta don't know what that will be at this particular point in time. So they kind of book it at a fictional number. And the real number never ever shows in the accounts. Is that right? There's never an adjustment made subsequently?
Correct. It never shows up on the rest. The other 22 billion does not show up on the P&L.
Wow.
Now, one other thing, which is to me really cool, I'm going to geek out on this for a minute. This is the only expense I can think of, stock-based comp, where when I give it to you, it lowers your operating income, because most of the time this is going to be in SG&A or operating expenses. And it also is eventually included, let's say, in your diluted share count. Let's say there's no buyback. It also shows up in your diluted share count. So it's hitting your earnings per share twice.
Wow.
So let's just say there's no buyback for a second.
Yeah.
Well, I give you, you have the RSUs or what have you. 20.427 shows up in my P&L, so it hits the earnings per share there, obviously, because it's an expense. But then when the shares vest and become live shares and they're trading in the market, now they show up in my diluted share count in full. So that 63 million that we just saw, that's going to show up in my share count in full if there was no buyback. So it hits my share count, which means it hits diluted EPS twice.
Right. I mean, I'm looking at the screen you're showing now, and I'm looking at the cash flow from, financial operations.
Yep.
And you've got the 26,248 number there, and then an 18,4 number above it, which takes us close to the 42 number we mentioned before.
Yes.
So are we effectively saying that that 42 appears in the financing cash flows, but of course
Exactly
that
right.
doesn't get included in the free cash flow numbers and the adjusted earnings numbers that the
Right.
company puts out and the investors value a company against?
Yeah, and this is where it gets really cool, James, because if you take 115.8 cash from ops and obviously deduct capex of 69,691, we get about 46 billion in free cash flow.
Mm-hmm.
Now, just go with me on this. I'm just going to make it up. Let's just say you think that Meta is worth 20 times free cash flow. Well, 20 times 46 is about a $920 billion market cap. I'm not saying that that's what Meta's worth. Just go with me on this example. Fine. So then you decide to buy all of Meta, and let's just say you could buy it for $920 billion. So you're the sole shareholder now. Well, then at the day after you buy it, you're going to realize, man, we're not making as much cash flow as I thought we were. I thought we were making 46 billion a year. I was going to get in free cash flow. You're still paying your employees because now you're not going to pay them in stock, but they're going to demand payment for the shares that they used to get.
Yep.
So at that point, you're going to realize, oh, wait a minute, there's another roughly $42 billion my employees are screaming that I owe them. So really, my free cash flow is not 46; it's like 4 in this fictitious example.
Yep.
So you're making 4 billion a year in free cash flow, but you paid 920. So your multiple goes from 20 to something astronomical really quick.
Yeah, yeah. And it gets worse than that, doesn't it, Kevin? Because, essentially when the company does buy back shares to offset dilution, it does so regardless of price. It doesn't look at fundamentals. It doesn't look whether the share price is overvalued relative to intrinsic value. So essentially what it's doing is it's creating a great deal of artificial demand for the shares, which pushes up that share price. Essentially, you've got insiders who are granting themselves stock and inflating its value. I mean, as Charlie Munger always used to say, show me the incentives and I'll tell you the outcome. And that seems to be exactly what's happening here.
But as you and I both know, as investors, I'm worried about capital allocation. The last thing I want to start doing is overpaying for assets, including my own.
Yep. And if looking at these Meta numbers, they're repurchasing, what is it, 40 billion of stock on an annual basis. That's artificial demand wouldn't have otherwise existed, but for the need to offset dilution, which is inflating the value. And then you've got these passive investors who readjust their portfolios based on market cap. That's the way the index works. And then you've got more stock-based comp coming through. And so the whole thing just spirals higher and higher and higher until, the stock price doesn't reflect reality anymore. Is that the case?
In my opinion, yeah, especially the last part, that the stock price doesn't reflect reality, unless in the example I gave you, and it's not that far off from the truth. If you do believe that Meta is worth 20 times, and what would that be? 920 over 4 billion now we calculated roughly. So it's whatever 920 over 4. It's a hell of a lot bigger than 20 times multiple.
Yeah.
Now, for fun, for your viewers, because they have 3 years worth of data here, and they have 3 years worth of data on the statement of changes of shareholders' equity. So you can do the math on this. If you go back and were to make the math calculations that I just showed you guys and applied it to Meta's free cash flow, you will see a long slide in free cash flow downward since 2023, because they've been buying back. The stock's been getting more expensive. The amount that they're spending on that's getting obviously a lot more than it was. 24 is higher than 23, 25 is higher than 24. And so their free cash flow just keeps cascading downward, even though their cash from ops continues to increase at a pretty healthy rate. And what's funny is a lot of these hyperscalers right now are saying, oh, well, we're borrowing money, putting debt on our balance sheet to pay for our CapEx. Technically, that's true, but I can also technically make the argument that you're just borrowing money to pay your stock-based compensation, because if we didn't have to do the $42 billion in 2025 for Meta, would I have needed to borrow that 29,906 at the bottom for in the financing for debt? Probably not.
Yeah, I did. I ran some back of the envelope numbers before this conversation, and it appeared to me that between 2014 and 2024, so a decade-long period, Meta spent $148 billion on buybacks, but the share count only reduced by 4%. And I kind of calculated that at least 82% of that 148 billion that was spent on buybacks was to offset stock-based comp. And
And if they did spend that much on repurchases and their share count hasn't moved, then you just correctly answered the question.
yeah,
In my opinion, just my opinion. But
yeah. Okay. So, is there anything else to note on Meta before we move on?
other than so we have their P&L next. Just remember, so for me on the P&L, I'm going to take that 83,276 income from operations. I'm going to add to that 24,27, the gap stock-based comp. I'm going to add that back because I think that's a garbage cost. And then I'm going to deduct the roughly 42 billion that I calculated for stock-based compensation, the true cash cost, and that gives me my operating income.
Right.
Other than that, no. But like those are the adjustments that I make in my own portfolio. Of course, what I try to do is make sure I don't own companies that have massive amounts of repurchases just to offset dilution, but that's different.
Yeah.
Um,
But I mean,
so that's it.
the problem seems to be that Deutsche Bank Asset Management ran some analysis a while back. I remember reading it, and they calculated that I think between 2009 and 2019, companies in the S&P 500 had spent over 4 trillion in buybacks, primarily to offset dilution, and that had effectively created this asset bubble. But of course, stock market investors seem to turn a blind eye to what's going here with stock-based comp, and I think the reason for that is because the value of their equity is being pumped higher. So you've got, I don't want to use the word Ponzi scheme, but you've got this kind of environment where shareholders should be calling this out, saying, well, hang on a second, this is our capital. It's being transferred into the pockets of insiders. We're not happy about it. But of course they don't, because they see the value of their equity climbing. I mean, a great example is if you look at Apple. I think Apple between 2022 and 2024, if I'm not mistaken, top line and bottom line both declined in that 2-year period, and yet the share price doubled. And most of that was because of stock-based comp.
Yeah.
And so there is an issue here where shareholders aren't calling it out because they're kind of happy with the way the stock price is pumping, and until of course it stops being pumped and the whole thing implodes. So arguably this is something the regulators should be looking at. No.
I mean, it's hard for me to say on the regulators only because, like I said, everybody's following GAAP. Like the rules are set. I don't have a problem with the way the rules are written because I understand why FASB wrote them the way that they wrote them. A share issuance is a financing activity. A share repurchase is a financing activity. And like I said, that's why FASB and IASB says, look, these statements are meant for, quote, knowledgeable users, end quote. And so it's like me going to Las Vegas. Like, I don't really know how to play poker, but I can go sit down at a table and play. And the only thing they're going to tell me is, look, you understand the risk that you're taking. Play them if you want to, but I don't know what I'm doing. So if that's the case, I don't think that's necessarily a regulatory thing, but I do think that investors should be more knowledgeable. And to your point, I agree with you because I was at a conference recently where I presented something on this, and somebody stood up and said, "Look, I've struggled with this for 20 years. You're technically correct, but if I didn't, or if I paid attention to this, I would have missed the big run up in Meta stock over the last 5 years or whatever." And I was just sitting there thinking, I don't disagree. Neither one of us is wrong, but I just don't want to invest money that way because, in my opinion, this is a real cost. And if the market does figure it out one day, it could be ugly for for companies that are doing this in mass. And to me, as a Buffettologist, so to speak, for lack of a better word, I want to know what the true cash generating capability of the business is. So my suggestion for companies would be to actually report the amount of cash that was spent to offset dilution. That we have all these adjusted numbers anyway, adjusted EBITDA and adjusted free cash flow and all this other stuff. Put that in there. And in Meta's case, it's particularly interesting because in their earnings release every quarter, the last table that they always give is an adjusted free cash flow number. And they calculate free cash flow the way we always do it, cash from operations plus CapEx, which is, of course, a negative number. And then they say, hey, don't forget to deduct the principal portion for finance leases. So on their statement of cash flows, third from the bottom, you'll see 25, 24. In my financial statement analysis course, I always tell my students, I don't care if it's an operating lease or a finance lease. You needed the lease to run your operations, so you should adjust for this because an operating lease is in operations. The principal portion of the financing lease is not. So I would adjust that 25, 24 to come out of 115,800, their cash from ops. Meta does that, but they ignore stock-based compensation. And so it's like, well, guys, just do both. Just do both, and investors can make the decisions that they want to.
So there's an inconsistency in their approach. They're treating different line items in why. So is this something the auditor should be on top of?
No,
Sure.
no, because the auditor is just there to make sure that the books are following the rules. And again, and all of this follows the rules. Like I'm not saying any of these companies are committing some kind of fraud. They're not. And as a matter of fact, Look at the disclosures I just showed you. It's on the statement of cash flows. It's in the footnotes. All the information's there. To me, this is an investor problem, not a regulator problem or anything like that. But when I saw that Meta was adjusting their free cash flow for the principal payment on the lease, I'm like, but not the stock-based comp.
Yeah. Yeah. Interesting. Okay, so we've kind of dug into Meta, which has been fascinating. Are there any other companies that do it differently that we should look at just to give us a contrast?
So to stay in the Mag 7 world, so to speak, I thought it'd be fun also if we looked at Amazon. So here's Amazon's cash flow statement. And they owe like few companies, they actually give their cash flow statement first. Most people start with their P&L or their balance sheet. They give cash flow first because we all know Bezos has always been more about cash flow than GAAP profit. So we could see it on here. They have stock-based compensation in 25. Hang on, because they have theirs a little different. Of what is it, 19.5 billion. So their stock-based comp has actually gone down over the last couple of years. It was 19.5 billion. We have their cash from ops at 139. We have their capex. A lot of that's obviously for AI. And then when I go into the financing section, I don't really see anything for stock-based comp. So clearly they're not doing a share repurchase. All right, so when you don't have a share repurchase, you're not offsetting dilution, obviously. So then we have their P&L. We can come back to that. I go into their statement of stockholders' equity, and I see 138 million shares right at the bottom were issued for 19,161. All right, fine. Now, these are all positive numbers. So again, no buyback here. So it's clear they're not repurchasing stock to offset dilution. So then what I like to do is see if I could tie it out to the footnote. And in their stock-based comp footnote, right at the bottom, I see 138.1. And so we know how much this cost them in GAAP costs. So that 138.1 cost them 19.16 billion. Over here in the year before, I have 210, and then I have 141. What excites me about this, James, is that then I have 210 and essentially 140. The point is the numbers tie out pretty clean. A lot of times they're like off by a little bit because there's just other things in there. There's ESOPs or whatever. We don't have that here. So Amazon is very clean in their presentation, if you will, because there is no share repurchase. So when I look at Amazon, I don't have to make an adjustment to their financial statements because there is no cash cost because there is no buyback. And so my guess, and it's just a guess because I wouldn't know from reading the 10K, I'm assuming they're doing sell to cover, not net share withholding, so to speak. That's what Meta's doing. The latter is what Meta's doing, where they're saying, look, I gave you 63 million RSUs, but I'm going to withhold 27 and pay your tax. I don't think that's what Amazon's doing. I think what Amazon's doing is sell to cover, where they give the employees the stock. And when it vests, the employees sell it, they pay their tax, and they get the remainder. It's off Amazon's books, so to speak. So Amazon is nice and clean in this regard. Like there's nothing for the investor to do here other than to acknowledge, okay, 140, 210, 140. When those vest, they become live shares. They are diluting shareholders. It's ending up in the share count, but that's just the cost of issuing shares. But that's really easy. You'll see it right in the P&L and the diluted share count down below. You'll see it increasing over time, and so that's essentially a function of the shares being converted upon vest. But that's it. There's nothing else to do. The one thing I would adjust to the P&L actually. So remember, on their statement of cash flows, they are adding back this stock-based compensation expense. Investors may want to do that in the P&L as well. They may want to add back those numbers to operating income because remember, there's no buyback here, so there's no cash cost. So because this is not a cash item, I don't want the expense on my P&L. I want my net income to get as close to cash flow as humanly possible. So on the statement of cash flows, we add it back to net income to get to cash from operations, but we're not doing that on the P&L. So my suggestion would be to add it back to SG&A to get SG&A to get your true operating income. And then the dilutive effect of this on the share count shows up in your share count. So this way, we're not actually nailing Amazon's diluted EPS twice. One for the GAAP cost of stock-based comp, and then two for the dilution. So actually, Amazon's P&L might be understating their profitability.
But essentially what we're saying here is that, Amazon is showing integrity here, all right, in the way they show their numbers, and investors should take comfort in that.
I believe exactly. And that's, as an investor, of course, transparency is very important. So when I look at some companies that give you the numbers but don't really talk about them, it's like, well, you could have talked about them. To where, to your point, with Amazon, they're giving you the numbers. Obviously, to your point, their way of compensation is very clear. I don't really see any problem, at least at this level.
Yeah, and then the fact they're not trying to offset dilution is also a great sign, right? They're effectively allowing shareholders to see what the employment costs are,
Yep.
rather than trying to conceal them.
Yep.
Yeah, that's fascinating. So in terms of free cash flow, we mentioned earlier that Meta's free cash flow looked far greater than is actually the case.
Yep.
In the case of Amazon, the free cash flow that they show, is that pretty close to reality?
Yeah, yeah. I mean, I would, me personally, I would still adjust for the principal repayments of financing leases, which in 2025 was 1557. But other than that, yes, there's not some grand adjustment that I believe we're supposed to make and all this other stuff. And so that 139,514 plus the negative 131,819 seems legitimate, which, in my opinion, is one of the reasons that you really haven't seen Amazon, other than in 2025, have to take on a bunch of debt, because the debt that they are taking on is truly going for those AI investments, I believe, to where other companies are saying, well, no, we're doing it for AI. And it's like, yeah, but you're ignoring that elephant in the room that just so happens to be the cash you're paying for stock-based comp.
Yeah.
So I could just as easily say, well, the debt is really just to pay your employees because it's a one for one no matter what. Sure, say it's for the AI, but it could be for that. It could be for the employees. So where with Amazon, there is no offset for dilution. So it's got to be for the AI investments.
Absolutely. And there are other companies which do this differently. Fairfax Financial is a good example. They also don't offset dilution in the market. In fact,
Mm-hmm.
the way they seem to do it is that at the point of granting the shares, they buy them in the open market and they hold them in treasury until vesting, so that shareholders know on day one exactly what the cost is. And it's precise accounting. There's no dilution games going on. Have you ever looked at
Yeah,
that or any similar company?
I haven't. No, I haven't looked at them. I mean, honestly, most of the time, this isn't an issue for most companies, or I'll say it this way: a lot of companies are doing it, but when I take their reported free cash flow versus what I call my adjusted free cash flow, they're within 95%, right? So it's not a big hit. So if the market were to ever correct for this, maybe you see a 5% drop in the stock price if it was really that technical. Most companies, that's how it works. My problem is with a lot of the Mag 7 right now, they're 35 or 40% of the S&P 500. We're basing that off of what might be considered very inflated free cash flow numbers. And so that's a bit of a problem, especially because a lot of these companies, as you know, with the AI build out and whatnot, and we can talk all day about whether it's a bubble or not, but with so much money being spent in dilution to offset stock based comp, and 40% of the S&P 500 or 35%, whatever it is in these seven companies, that could be a very serious problem if one day the market ever wakes up and says, hey, you guys are spending far too much on compensation. And you have good analysts out there like David Zion at Zion's Research Group, who I've always respected, especially I think he's the best analyst on the street over the last 20 years. And then Michael Burry, I know, has made some posts calling this out. I haven't looked at their math, but I mean, directionally, I think those gentlemen are correct in what they're talking about. So if this ever did get a lot of momentum, it could become a significant issue for a number of companies that are a significant percentage of the stock market capitalization.
Yeah, Michael Burry called out Nvidia recently, didn't he? Their response was interesting. What did they say?
My understanding is their response is, well, Michael said that we bought back 112.5 billion in shares, and that's used to offset stock-based comp. The math is wrong because we bought back 91 billion shares. Okay, and it's fine. Let's say that they're right, and his math is wrong. I have no idea, but let's say that they're right. They never challenged the point, though, that the stock buybacks are going to offset dilution. And I just wonder if some of these companies will go back to the argument that they tried to make 25 years ago, where it was, well, but this is really more invested capital. We're investing in our employees and blah, blah, blah. And I'm sitting there thinking, okay, then in a return on invested capital calculation, either deduct it fully from the numerator, your NOPAT, or capitalize it and put it in the denominator. And neither of those are happening. So if you want to consider it invested capital, then show it properly in your ROIC. And honestly, James, that's one of the big problems I have with this, with people not adjusting this, is because they're looking at these companies doing this. And whether you use net operating profit after tax, a traditional numerator for return on invested capital, or you just want to use cash from ops as your numerator, both appear to me to be overstated. And then your profit margins are overstated. Your return on assets, your return on equity is overstated. The cash flow, whether you want to use EBITDA, cash from ops, whatever, for your credit risk analysis is overstated because this doesn't show up there. It's not adjusted in that either. And so there's a whole slew of metrics that investors look at that could be overstated, showing better performance than is real. Or said differently, your credit risk or whatever appears to be understated. So dangerous game that some of these investors are playing by, in my opinion, by not paying attention to this.
The way you describe it, it sounds like a game of Russian roulette, right? Some of these companies are overinflated and someone's going to be left holding the baby.
Well, and this is a fair point. And I mean, this is where I worry about some of the AI build out, because what we're doing with a lot of these companies is we're taking companies that used to be very capital non-intensive, right? They didn't have high capex or any of that. They had very nice balance sheets, great cash flows, to where now they're dumping all this money into hard assets, right? Capex, and they're leveraging up their balance sheets. And so I'm just sitting there thinking, okay, that's fine. As long as you know the return is there in the time frame investors expect it, okay. So there better be a payoff, one. But then please don't tell me that we're just doing all of the cash flow that we say we're generating and giving it to employees. Because even if the payoff is there for AI, there's still not going to be anything left for the shareholders because we spent all the money and gave it to the employees. So I just keep looking at this thinking, if I'm the investor, what am I getting out of this? Again, if I were thinking of buying the company outright, which, as you know, is the way Buffett would look at it.
And these companies will argue that stock-based comp aligns interests. In terms of this alignment thing, I've never really bought it myself. If you and I invest in whichever company it may be, let's say Meta, because we spoke about them earlier, then, we're taking risk. We have downside risk, but we hope that, the risk reward skew is in our favor, and we're going to make more than we stand to lose. But nonetheless, there's a balance there.
Mm-hmm.
When you've got insiders being gifted stock, it's effectively a heads I win, tails I don't lose kind of scenarios, right? So there's no alignment there. It's a different kind of mindset. The other thing is that, an investor, if you like a company, whether it's Meta or otherwise, you're buying to hold. And when employees are gifted stock, they see it as salary. There's a delayed vesting, right?
Yeah.
So they can't spend it straight away, but in their mind, they've spent it. They bought a new house, a new car, whatever it might be. So whereas external investors are buying to hold, employees are holding to sell.
Mm-hmm.
There isn't an alignment. That's a misalignment as far as I'm concerned.
There used to be, it used to just be mostly options. And the way an option works is similar to an RSU, except for one very key difference. So let's go back to the example of I give it to you at, we say it's worth 30 at the grant date. That's what we expense it for. You sell it for 90. If it's an option, you're going to get 60 in compensation because you're going to sell the option in the market at 90, but you have to give the company 30. So they're going to get 30. You used to see this all in these statements of cash flows. You'd see these cash inflows from stock-based comp. So if that were the case, I would take that out of my true cash cost, right? So like if it were an option and the company were to buy the stock back at 90, I would say they bought it back at 60 because they did pay 90 in the market, but they got 30 when you exercised your option. They got it from you. So there's that. We've shifted mostly to RSUs, like stock option usage is just going down and RSU, PSU usage is going up. Now what happens with an RSU, I'm still expensing it at 30 as the company on my P&L, but I don't get any inflow from you when it vests. So when it vests, you get a share, you sell it at 90, you keep the 90. And you obviously pay your Fed tax on that. But as the company, I don't get the $30 inflow anymore. So the RSUs are even more beneficial because you had said it's a heads I win, tails I don't lose. That's even more true with options and PSUs because under an option, if the stock price, when you got it was at 30, it went up to 40, and then all of a sudden it sunk to 20, you're underwater. You're not going to exercise your options. With an RSU, when they vest, you're always going to get something as long as the stock price is greater than zero. The other component is what we do under GAAP by expensing the 30, that's fine. That's not what the IRS does. The IRS uses what's known as the intrinsic value method. It's essentially cash-based accounting. So whatever the market price is essentially what's going to get reported on the tax return. So on the taxes, the IRS doesn't care about the 30, especially with an RSU. They don't care about that at all. The company gets the full deduction at 90.
Right.
So there's an additional tax savings for the company because of it. And you used to actually see that on the statement of cash flows. But then in 2016 or 17, there was an accounting rule change that moved that tax benefit from financing to operating. So all of the taxes are an operating activity, but the actual buyback, if you will, is still a financing activity. So the tax withholding that we looked at for Meta, financing, the repurchase to offset dilution, financing, but it's called an excess tax benefit that they put on their tax return. That's an operating activity. So I always found it interesting that part of this is operating, but the bulk of it is still financing.
Interesting. So as shareholders, what can we do about this? Is there anything we can do, or do we just avoid the companies that abuse stock-based comp?
Me personally, I avoid the companies that abuse stock-based comp. The other thing is, I mean, shareholders can always try to contact FASB and say, hey, why don't you make a recommendation that if companies are going to give, well, even if they're not going to give non-GAAP numbers, they should at least have a disclosure of how much cash was spent to offset dilution, both on the repurchase and the tax withholding, get the number that we talked about. They could do that. But I really think it would have to come maybe from the FASB and or SEC or whatever to say, all right, we get it. We do agree. This is a real cash cost. We should at least disclose that separately. And then investors can utilize it if they want to. But if nothing ever comes out of this from a regulatory perspective, then investors should at least be more knowledgeable and understand, look, you can invest in a company that's doing a ton of this if you want to, but just understand that it might not, what they're telling you is their free cash flow might not be the real number per se.
Mm. Something I've always struggled with, you can help me understand this. I come from a legal background, not an accounting background, so forgive me if this is naive. But essentially, companies will argue that they pay stock-based comp instead of cash because it preserves balance sheet cash, right? So what they're effectively claiming is it's a non-cash item. There's no cash leaving the building today, but they're assuming a deferred liability. So it should appear on the balance sheet as a liability and then mark to market over time based on the movements in the share price. Never understood why that's not the case.
It is all right, in certain instances, it is. There is a very large bank that everybody would know that in their footnotes, they talk about this. And they say, look, we gave employees, whatever, options, RSUs at 30. That's what we initially expensed it at. A year later, the stock was at 45. We did mark it up and reflect that in our P&L because I don't disagree. I would much rather prefer a mark to market on this, but that's it's an option that people can use. But I've seen, God, only a handful of companies ever use it.
Well, this has been a fantastic discussion. Is there anything that we haven't discussed that you think we ought to throw out there?
I don't think so, and I've beaten this up pretty good, especially over the last couple of weeks. So we'll see if there's some interesting news stories that come out about this. I'm hoping that they are because I've done all the interviews and everything else. So we'll just see where it goes. But this is something that, especially in the last, let's say it's February, in the last 3-4 months, has gotten some attention, especially because of some work that David Zion and Michael Burry have done separately, of course, and all that. So we'll see. But no, there's nothing else that I could think of at the moment. Just to be determined as to what eventually comes out from this.
Yeah. Okay. So the takeaway message, I think, for listeners is just be more choosy when it comes to investing. Take a look at these numbers. This is something perhaps you haven't looked at in the past. Perhaps it will be something you'll look at in the future. Well, Kevin, thank you very much for your time. It's been fascinating.
No, truly my pleasure, James. I appreciate you having me on. Thank you.
So, what did we actually learn today? Paying employees in stock is not inherently a problem. In fact, in many cases it makes perfect sense. While for a cash-generative company paying entirely in cash may be cleaner, equity compensation has advantages. For example, delayed vesting supports cash flows, it can be tax-efficient, and it helps retain talent by making poaching more difficult. The issue isn't stock-based compensation itself. The issue is how it's managed. Some companies handle it well. Take Amazon. Over recent years it's diluted shareholders by a little over 1% annually. Over the same period, revenue and market value have compounded at strong double-digit rates. The real growth rate, even after dilution, remains very attractive. In that context, equity compensation does not undermine the investment case. It supports it. More particularly, Amazon is honest and transparent. Investors can see the dilution. It isn't hidden from them and no corporate capital is wasted in trying to mask it through buybacks. Contrast this approach to that of most other large technology companies including Meta, Alphabet, Microsoft, Nvidia and Apple. Their approach is entirely different. They issue so much stock to employees that they are compelled to buy back shares simply to mask what they're doing. It's a wealth transfer mechanism at scale. It amounts to very poor corporate stewardship and awful capital allocation. Investors also need to be aware of an accounting blind spot. Equity is granted today, but it vests years later. The economic cost doesn't cleanly pass through the profit and loss statement. It doesn't fully show up in operating or free cash flow numbers. So the result is a distorted picture of profitability and cash generation, which leads investors to misvalue the business. The problem worsens when these companies repurchase stock irrespective of valuation, so the distortion deepens. Capital is deployed to support per-share optics rather than to generate incremental returns. Over time, valuation detaches from underlying economics. Market capitalizations inflate. Then, because index funds allocate solely based on market cap, as valuations rise, passive flows increase. That amplifies the valuation distortion. This dynamic is what concerns Michael Burry. It's why he has withdrawn from the game. It may also help explain why Warren Buffett has significantly reduced exposure to Apple, once his largest holding, and why Berkshire Hathaway is holding over $350 billion in cash. Sitting on cash is not inactivity. It's a capital allocation decision. Just like Burry, Buffett has decided to step out of the game. The broader lesson is simple. Don't be indifferent to stock-based compensation. Track repurchases. Ask whether buybacks are creating value or masking a transfer of wealth. Adjust GAAP numbers. Don't rely on third-party screeners which run unadjusted numbers. In short, keep your eyes and your mind wide open before making investments in popular stocks. We hope this was helpful and we wish you every success in compounding your own wealth.
We really hope that you enjoyed today's podcast, but we really only scratched the surface. If you want to explore any of the themes discussed in more detail, see the show notes or visit us at rockandturner.substack.com. Oh, one more thing. Be sure to like the episode, share it with others, and save it to your favorites so that you don't miss future episodes. Until next time, we wish you every success with your investments.